Hello, and welcome back to the channel. I'm Algabot, and this is where we break down automated trading strategies for MetaTrader 5 in plain, practical language. In today's video, we're examining an expert advisor called Failed Auction Reversal. It's a pure price action approach, with no indicators at all, that studies the moments when a push to a fresh high or low is rejected by the market and price snaps back inside its recent range. Over the next several minutes, I'll walk you through how it reads the chart, the exact rules it follows, the code that runs behind it, and a visual example. Everything here is educational only, so let's get started. Let's start with the big picture. Failed auction reversal is a counter-trend strategy, which means it looks to enter against the most recent short-term move rather than with it. The central idea is the concept of a failed auction. In market terms, an auction is simply price traveling in one direction to find willing buyers or sellers. When price pushes to a brand new extreme, a fresh high or a fresh low beyond its recent range, but then fails to hold there and snaps back, that rejection can be read as a sign that the move ran out of willing participants. The strategy aims to identify that specific event and respond to it. What makes this expert advisor distinctive is that it uses no indicators whatsoever. There's no moving average, no oscillator, nothing calculated on top of the chart. Instead, every decision comes from raw candle geometry measured against a swing window. The expert advisor looks back over a defined number of recent bars, finds the highest high and the lowest low of that window, and then studies the most recently closed candle to see whether it probed beyond that range and was rejected. In terms of markets, this approach was built with Euro to US dollar and XAU/USD on the 30-minute time frame in mind, though the logic is generic enough to study on any liquid symbol or time frame. It's best suited to traders who are curious about pure price action structure and who want to understand how breakout failures can be defined mechanically, without subjective judgment. As always, this is educational content. Trading involves real risk. Losing trades are a normal part of any strategy, and nothing here is financial advice or a recommendation. The goal is simply to help you understand how this particular set of rules is constructed and how it behaves on a chart. Now let's walk through exactly how the strategy reads the chart. The expert advisor works on closed bars, acting once each time a new candle opens. First, it needs enough history, specifically the lookback window, plus a couple of extra bars. It also keeps things simple by holding only one position at a time. The next step is to define the structure. The strategy looks at the candles before the signal candle, scans across the lookback window, and records two values, the highest high and the lowest low of that window. Together, these form the recent range that price has been trading within. The height of that range matters too, because it sets the scale for everything that follows. Then the strategy examines the most recently closed candle, the signal candle, against that range. Consider the short setup first, which is a failed upside auction. For conditions must all line up. The candle's high must push above the prior range high by a meaningful amount, defined as a fraction of the window's height, so a trivial one-tick poke doesn't count. The candle must then close back below that prior high, meaning the breakout was rejected. The body must be bearish, with the close below the open, and the close must finish in the lower third of the candle's own range, showing a decisive snap back down. When all four are present, the strategy signals a short. The long setup is the exact mirror at the bottom of the range. The candle's low must probe below the prior range low by the same minimum fraction, the close must recover back above that low, the body must be bullish, and the close must sit in the upper third of the candle's range. When those align, the strategy signals a long. Risk control is structural. On a long, the stop is placed just beyond the rejected probe low, with a small buffer measured as a fraction of the candle's range. The distance from entry to that stop becomes the defined risk. The take profit is then set at a fixed risk-to-reward multiple of that risk, with a default of 2. The short setup mirrors this, placing the stop just beyond the rejected high. Because the stop sits where the idea would be proven wrong, every trade carries a clearly defined risk before it's ever opened. Let's read through the code you see on screen, just as it appears in MetaEditor. At the top are the input parameters, the dials you can adjust before running the expert advisor. Lots controls the trade size. Lookback sets how many bars form the swing window. With a default of 18, a larger value defines a wider, slower range. while a smaller one reacts to more local structure. PenetrationFrac is the minimum probe beyond the range, expressed as a fraction of the window's height, so the breakout has to be genuine rather than a tiny poke. Close location defines how close to the far end of the candle the close must finish, controlling how decisive the snapback must be. RiskReward sets the take profit as a multiple of the structural risk, and BufferFrac adds a small cushion beyond the rejected wick for the stop. Now the signal logic. The variable named failed high describes the short setup. Reading line by line, the candle's high must exceed the prior high by at least the minimum probe, the close must fall back below that prior high, the body must be bearish, and the close must sit in the lower third of the range. Every condition must be true at once. The failed low variable is the exact mirror for the long setup at the bottom of the range. Finally, the risk lines. The buffer is a fraction of the candle's range. On a long, the stop is the probe low minus that buffer, and the take profit is the entry plus the risk to reward multiple times the measured risk. Clean, structural, and fully defined before entry. Let's bring this to life on the chart. The two blue lines mark the swing window, the highest high and lowest low of the recent range. Notice how price spins the early candles drifting lower, settling toward the lower blue line that marks the window low. Then watch the fifth candle. Its wick stabs below that line, printing a fresh low beyond the range, which looks at first like a downside breakout. But price refuses to stay there. The candle closes back above the window low with a bullish body, finishing in the upper part of its range. That is a failed downside auction, and the strategy signals a long entry, shown by the buy marker. From there, price recovers and climbs steadily through the next several candles, moving up toward the structural target. The take profit marker shows where that long position would close at the predefined risk to reward level near the top of the range. Now watch the upper blue line. As price reaches the ninth candle, its high spikes above the window high, printing a fresh high beyond the range, again looking like a breakout. But just like before, the move is rejected. The candle closes back below the window high with a bearish body, parked in the lower third of its range. That is a failed upside auction, and the strategy signals a short entry, shown by the sell marker. Price then rolls over and falls through the following candles until it reaches the second take profit marker, where the short would close at its risk to reward target. Two clean examples, one long and one short, both built from the same failed auction logic. This is an illustration for educational purposes, not a prediction of real outcomes. So that's the failed auction reversal expert advisor. We covered the core idea of fading a failed auction, the exact entry conditions for both long and short setups, the structural stop and the fixed risk-to-reward target, a line-by-line look at the code, and a visual walkthrough of how it reads the chart. Remember that this strategy uses no indicators at all. It's built entirely on raw candle geometry against a recent range. Everything in this video is educational content only and is not financial advice or a recommendation. Trading carries real risk, and losing trades are a normal part of any approach. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like analyzed next, and subscribe for more MetaTrader 5 strategy studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.